Welcome back, guys. Appreciate the subscribership. We're going to get right into the stock market technical analysis. I want to start out today with a picture or a chart here of the dollar, because the dollar has been kind of the big thing moving right now, and we're seeing that in gold and silver. So I want to go ahead and just point this out. This is something I've been talking about for about a year and a half. Some of my earlier videos was talking about how the dollar was going to go down, and the dollar continues to go down over time because the monetary system that we live in pretty much relies on the dollar continuing to lose value. You can see here, going back to 85, this is when the DXY, which is the dollar, the dollar ETF that we're tracking, kind of started. But in the 70s is when they took us off the gold standard, and that's pretty much when the dollar started losing value because they started printing, and this is kind of the longer term debt cycle that we've been in. When the interest rates started up around 18-19% after the 70s, the huge 1970s inflation era, and then they jacked interest rates up, killed inflation, and then ever since then, they've been dropping interest rates and stimulating the economy and the stock market. So when people say, what I want to cover is, it's a fallacy that a lot of financial advisors and just people that are living today basically think stocks always go up over the long term. And this just simply isn't true, that stocks always, because over the last couple crashes, the Fed's been able to come in and reinflate the bubble each time. In the dot-com bubble, they started dropping interest rates. In the Great Recession, they started dropping interest rates. And now they've started to do the same thing, but now they don't have interest rates, so they're trying to pump money. And really, if you go back and look at some of the economic crashes like the Great Depression, it took stocks 20 to 30 years to actually break even again, to come back to their former highs. And that doesn't include dividends, but that's just price. And so the reality that stocks, when they go down, they just come right back is only true under this long-term debt cycle, because the Fed, since the 80s, has been reinflating the bubble. The Fed doesn't have the power to do that as much anymore. Now, yes, they can do it through sacrificing the dollar, and that's what we're seeing. We're seeing that the Fed is pushing the dollar down, printing a bunch of money, trying to reinflate the bubble. And this is anybody who's alive today who's been investing, they've experienced this. So that's where they get the fallacy that they think interest rates or stocks always go up, because, when you have a crash, like the 87 crash, then they dropped interest rates, killed the dollar. Then you had the 2001 dot-com bubble. They dropped interest rates, killed the dollar. Then you have the Great Recession. Right? The Great Recession doesn't look like much, but there it is, dropped interest rates. And then the dollar rose, but now you're seeing massive money printing. So the dollar should continue to fall. We'll watch this. You'll start to hear about this probably from your neighbors and whatnot, but they'll talk about how everything's getting expensive or how groceries are expensive. And they'll think that what's happening is prices are just being raised. The reality is that their dollar is losing purchasing power, and so it's taking more dollars to buy the same amount of goods and services. So that's just something to watch. Here's what we're seeing, though. Let's jump over to some silver chart. Obviously, silver is just moonshotting right now. I'm not looking to chase this, even though it could just be getting started. Here's a weekly chart here, and you can see I tracked resistance right here on silver, right about where we're at 2078. We've overshot it just slightly on the weekly, but we'll see how that comes back, if that comes back to this 2078 and holds at resistance around this level. But again, the dollar's losing value, and other things are going up. So commodities look like a good move. One commodity I've been tracking is this coffee commodity, because it hadn't really moved too much, and you can see here that here's coffee today. I do own this. I never pointed this out. It just didn't seem right for everyone. It's really low volume trade, and I don't like to advertise the low volume option or stocks or ETFs too much. But again, up 6%. The point that I'm trying to make is you're seeing commodities go up. You're seeing gold go up. You're seeing silver go up. Everything priced. Corn's actually not going up today, so that's interesting. But and let's look at wheat here. Yeah, wheat's up slightly, but you're seeing things that are priced that are hard, tangible items, not the dollar. They're going up, and stocks go up, can go up with that. But realize that the purchasing power of what those stocks are priced in are actually losing value. So just going back to the dollar here, I think we're at support. If I roll out, here's the weekly chart, and you can see this blue line down here. This is your longer term support. I don't expect we're going to just crash right down and start to completely crash, especially today. We've got major earnings coming. That's going to have an impact on the dollar. So if we get a big sell-off in the market, I think that's what we're set up for with the tech stocks. But if we get a big sell-off, the dollar should hold strength, catch a bid, and rebound a little bit. So that's what it looks like is going to happen. Maybe the dollar rebounds up to here. Again, we're just going to have to watch it and wait for earnings. But I don't expect the dollar to just completely crash right down through long-term earnings right before major earnings. I don't expect it to crash right down through major support on the weekly chart right before major earnings. Although it does look like the dollar is destined to go a lot lower over time. So this is a longer-term play. And this is why gold has been... Flipping over to gold here, the gold bullion, you'll notice that, here's the thing, a lot of the narrative talk about how gold's rallying, and it's rallying because of the safety play, or people are worried about the pandemic. This just simply isn't true. Gold actually started rallying. If you go back here, gold started rallying and broke out. Here's your breakout right here in gold. This is a weekly chart right here. And we broke out back in June of 2019, well before the pandemic even was anything, really anywhere. Gold broke out. And gold broke out because the Federal Reserve did a 180, stopped raising interest rates, started cutting interest rates. So realize that the economy, and this goes back to the kind of the longer term thesis that the market is actually weak. The Fed started actually providing stimulus to the market back then, well before the pandemic, and it's only increased the stimulus. So the reality is that the economy is continuing to weaken, and the pandemic just was really a catalyst to really kind of another nail in the coffin, I suppose. So gold started rallying way back here. I pointed this out a long time ago. I pointed out this rounding bottom here a long time ago. So anybody that's been following me knew that this rounding bottom was a big consolidation pattern. We broke out, and sure enough, we've shot straight up. So now is not necessarily the time to just jump on the gold train. This is where we were buying gold and gold miners. Going back to Barrick, I was buying it down here, all through here. The things rallied from the lows here. The things rallied 200% now. So this is a lot of the time maybe the kind of a blow off move, or it's going to maybe pop higher and that'll be it. So be very careful jumping on the gold trade now. You want to buy these things when nobody else wants them, and when everybody wants them, that's typically where you want to be selling. So this is what we're going to continue to look at. However, the commodities still look pretty underbought, so maybe I'll cover some of that. Look at some of these commodities. They still look underowned. The commodities have been in a big bear market, and they look cheap, so we'll watch that. We also need to look at oil. That might be something that continues to rally if gold, or if the dollar continues to fall. Let's see how ExxonMobil's doing. Yeah, we're down today. Oil's a little tricky because oil is also demand based on economic strength, and there's just not a lot of economic strength right now. So oil isn't only a dollar weak or dollar negative play. It also comes to economic demand. So that's why I'm not a huge fan of oil at these prices yet. Okay, let's get into the charts. That's my fundamental rant right there. Just to give you kind of a backdrop in terms of what I look at fundamentally and how I'm trying to analyze the larger macro thesis behind a lot of my short-term trade ideas. A lot of my trade ideas come from a larger macro thesis that continues to be proven right. And so as long as that continues to work, the short-term trades are going to continue around that angle. Here's triple Qs. So I don't think we're going anywhere today. You know, we've got Microsoft earnings at the end of the day. So we're probably going to chop within this range here, and then we're going to make a move tomorrow. So where do we go? You know, I think Microsoft's going to miss. The only reason I say that is the chart looks to me like it wants to roll over down to this longer term support around 254. You can see that we had a nice lift off from that support line, and now we're coming back down to it. So to me, I think we're probably going to miss and head down to 254.70. And only reason I say that is because the chart looks like it wants to. You also had this bearish outside day candlestick. We did this little reversal, kind of a kickback rally right to the top of the candle, and then that since failed and continued to show weakness. So to me, this looks like it wants to roll over, and I think we'll probably get kicked off with Microsoft. So we're going to watch for that. We'll flip over to the SPY here, and then we'll look at Microsoft. The SPY. All right, so here's the SPY. Here's the thing we got to watch for. This island cluster top right here was negated because we traded above it. So you can't really take that into your your technical analysis anymore. However, it's still there, and we've broken above it. We haven't really impulsively moved too much higher. All we've done is chopped around, came back, did a little back test of the top of that gap, which is right about there, started to move a little higher, and we're just still within this range, just barely above this. It's suspect to me that we would break above this chart pattern right here, right before major earnings. And that's, we just did it the other day. We did it right before major earnings. Breakouts before major earnings, you're not going to have big hedge funds, big money movers taking big positions right before major earnings. And that's what we see in the volume. Going to the daily chart here, look at the volume on this breakout. Here's your breakout right here, and just anemic volume right down here. So this confirms that money managers, big banks, big trading desks, they're not taking big positions and taking this breakout. So this is a non-confirming breakout is essentially what this is. It's a breakout before major earnings with no volume. It's not confirming. Now, after earnings of Microsoft, if we get a big move higher and maybe we get big volume, okay, you could say that's probably confirming. That's a confirming breakout. But we just don't have it today. So that's just something to watch. To me, that tells me that this has a high probability of being a false breakout or a failure, and we break down starting here. But until we see it, we just don't know. Let's look at Microsoft. So Microsoft on the daily chart, obviously still above support. There's your trend line right there, just kind of walking up that trend line. But it does look like we want to come back down and test this support line and possibly gap below it. And that sets this up for a break. Like I said, I think that the tech sector is not going to give you an opportunity to just get out long. I think it's going to gap down. And that's usually how you trap the money. So I think that's what's going to happen. Could be with earnings. Maybe it's not. Maybe earnings is a non-event. It's hard to say, but it does look like this needs to come back down, probably tag support. And then from there, we'll see if it holds or if it breaks. You're seeing negative divergence in the RSI. So I think that Microsoft is due for a pullback. But again, we just don't know until we have earnings. So it's up to you to take a position before earnings or not. That's kind of a gamble, but that's just what I see in the chart. Here's Apple. This is interesting. Walking up the trend line right here, but we've started to break it. Here's your breakdown. Now, if I adjust my trend line just to be a benefit of the doubt trade, you could say it's here, but that only gives me 2 data points, here and here. And I never trust 2 data points. So having it back up here, I have a lot more reactions up here. You can see reaction, reaction, reaction there, reaction here. So this is the trend line. It's a more valid trend line. We're starting to break down prior to Microsoft earnings. So what does this tell me? If this closes below here, I think that sets us up for a gap down. tomorrow with Microsoft earnings. So let's watch for that. Could be a big gap down, and that's what it looks like it wants to do. I don't know if it's going to, but that's what the chart tells me it's going to do. So we're going to go ahead and keep watching this. Let's look at XLK, tech sector. Nothing here, just walking up the trend line here. I don't see anything bearish right now, except for the negative divergence on the hourly. You can see it right there. Big divergence. It's been going on for a while. So maybe that sets us up. But again, if Microsoft has a bad day or reports after earnings and it doesn't come out good, then this is going to probably at least tag the support line or possibly break. And I think it would break. But again, we don't know. Here's Snap. They did earnings yesterday, and they said their advertising revenue is weak. So what does that mean? Well, there should be correlation between Google, Facebook. Both of those rely heavily on advertising revenues. Those are two of the FANG stocks, so we're going to watch that. But here's what happened to Snap, down 6.5%. Here's the trend line. Could have been a day trade. I didn't catch it this morning. Slept in a little bit. But basically, it opened right below this support line that I had marked out and sold off. We're getting a little bit of a kickback rally, but ultimately, we're below support. So should head down to this 22.08. And then a break below that, and I see 21.40 as the next stop. So kind of watching those for signs of what might come for Facebook and Google. And Tesla reports after the bell. This one I just don't know. I'd like to take a position, and the position I would take would be short. That's just me. But I just don't know. They seem to gun this thing up with earnings. The way they do it is they'll just beat they'll sandbag the earnings expectations, and then they'll beat those earning expectations, and then the stock goes higher. So, I'm probably going to sit this one out till after earnings, but could be a big move. If they miss on earnings, then you would expect this to probably be down 10, 15, 20%, something like that, depending on how bad they miss. So we're going to continue to watch that, see how that looks. We could probably look to Ford for signs of how that might look. Ford doesn't necessarily look weak when I look at this. Continues to move higher. You've got a little bit of a trend line right here. It hasn't broken support really. So that's why I'm just not really. I don't have a position. I don't have a opinion on Tesla. So I'm going to go ahead and just sit that one out, see how that rolls out in earnings. And if I was going to take a position, it'd probably be a very small one. Tesla near-term support I've got here at 1546, just so in case anyone's looking. 1550, somewhere right around there. That's near-term support. And I've pointed out the gaps here at 1224 and 1128, and then 650 way down here. So that's that. Let's look at Adobe. This is a trade that I'm in. This one looks good. So again, here's what's playing out in Adobe. Just takes time to work out, but you have an uptrend line. That uptrend line was broken. You had, impulsively broken too, and that's what you want to see. You want to see a trend line break impulsively. That helps confirm that everyone who is watching that trend line realizes that the uptrend is now broken, and so they're exiting. They're getting out of that position. And that's what you see here with impulsive sell-off. See the volume? This is confirming. When you see moves that are breaking down or breaking up, look for volume. And that is what I mean about low volume. It's not about stocks moving higher or moving lower on low volume. Stocks can move on low volume. It's about breaking major levels on low volume. That is non-confirming. And that gives you the tell that the move has a higher probability of failing. And this is all about probabilities. This is a confirming breakdown, the volume here. And then we did the back test here, kickback rally, and we're still rolling over. So I think we're going to head lower, and we're going to break below these lows and set this in motion to start moving lower on the larger time frames, the daily. You can see here, kickback rally, breakdown, Now we need to make a new low heading down to about 410. And then, that will set the trend in motion for a downtrend. That's all I got, guys. Let me know if I'm missing something. Let me know if there's stock or an ETF you want me to look at. If there's a trade setup that you guys are watching, post it in the comments below. Let's help each other out. Appreciate the subscribership. Leave me a thumbs up. Catch you guys on the next one.